You ever stare at a price chart and just think the moves make absolutely no sense, that it's all just random chaos? Well, what if I told you it's not random at all? What if there's a blueprint, a hidden script that price is following every single day? Let's get into it. All right, welcome to AI Explains ICT. In this video, we're diving deep into the core content from month 5, episode 3. We are about to decode the market's entire blueprint, so you're probably going to want to grab a pen and paper for this one. It's that important. So, to get started, let's look at a puzzle, a specific moment on a chart that for most people would look completely and totally unpredictable. Okay, check this out. This is a daily chart of the Australian dollar. Back in November of 2016, you can see this huge market shift to the downside. I mean, price just absolutely falls off a cliff. But then, look what happens in late December. It stops on a dime and just aggressively reverses course, heading straight back up. So here's the big question. Was that reversal just a fluke? Was it random market noise? Or was it a calculated move that we could have actually seen coming? Answering that question, well, that's the key to everything we're about to cover. To find that answer, we need to pop the hood and look at what's really driving the market, what ICT calls its true engine. Now, this is where you kind of have to shift your whole way of thinking. The core idea here is that price movement is not a random walk. It's not chaos. It is guided. It is controlled. And it's delivered based on a very specific underlying logic. And look, don't just take my word for it. ICT puts it bluntly. An algorithm controls what price is going to do. It's absolutely not random. It's predetermined. That's the central belief we have to operate from. There is a script. And that script is run by something called the Interbank Price Delivery Algorithm, or IPDA for short. The easiest way to think of it is like a master program. Its main job, its whole purpose, is to seek out and reprice to specific data points on the chart, mainly where those huge pools of buy and sell orders are just sitting there, waiting. Okay, so if there's a blueprint, that's great, but how in the world do we actually read it? Well, you might be surprised to hear it's a surprisingly straightforward process. Let's break it down. It really just boils down to 3 key steps. First, we have to find what's called the quarterly shift. Second, we apply the algorithm's specific data ranges. And third, we confirm our analysis with institutional data. Let's walk through each one. All right, step 1. This is all about finding our anchor point. You're going to pull up a daily chart, and you're just looking for the last, most obvious, you can't miss it, major shift in direction that's happened in the last 3 months. That, right there, that's your starting block. We call that the quarterly shift. Once you have that quarterly shift, it unlocks the next part, the algorithm's targeting system. See, the IPDA doesn't just look around randomly. From that shift, it uses very specific look-back periods to find its objectives. It's scanning for data inside these very precise time windows. The algorithm is always looking back into the past, and it uses 3 key windows. The first one is 20 days. The next window it uses is 40 days. And the longest look-back period is 60 days. So you've got 20, 40, and 60 days. The crucial thing to understand here is that price is constantly referencing objectives found within these specific timeframes. So what's it looking for inside those windows? Well, it's hunting for 2 main things, liquidity and inefficiency. So that means it's targeting all those buy stops sitting above old highs and all those sell stops resting below old lows. But it's also on the hunt for imbalances, things like fair value gaps and liquidity voids. That's the treasure map. Those are its targets. So we have our reference point, and we know what the algorithm is targeting. The final step is all about confirmation. We need to see if the large institutions, the smart money, are actually positioning themselves in a way that lines up with our analysis. And the way we do that is by looking at something called open interest. This is just data from the futures market that shows us the total number of contracts being held. A sharp, sudden change in open interest right at a key price level, well, that's like a giant flare going up, signaling that the big institutions are making a major move. Okay, so that's the theory, and we've got our 3-step method. Now for the fun part. Let's go all the way back to that Australian dollar puzzle we started with and see if we can use this blueprint to crack the code. And here it is. This is where it all clicks. That major quarterly shift to the downside happened in early November. Now, what happens if we count forward 40 trading days from that point? Well, take a look. It lands you precisely on the exact low in late December. That timing wasn't random, it was programmatic. But wait, here's the confirmation. Look at this. As price dropped into that key support level, right at the 40-day mark, that purple line, which is open interest, absolutely tanks. This massive drop is a huge signal that institutional players were aggressively closing their short positions and likely buying everything they could. They were buying big time. And the result? Exactly what the blueprint suggested would happen. Price reversed perfectly, moving from a bearish environment, what ICT calls the sell side of the curve, into a bullish one, the buy side. And from there, it began its journey up, aggressively seeking liquidity at higher and higher levels. The puzzle is solved. Okay, so that was a lot to take in. Let's just quickly boil it down to the most important points you need to remember from all this. First, and most important, the market is not random. It's driven by the IPDA. Second, every 3 months, a quarterly shift gives you a brand new reference point to work from. Third, the algorithm is always targeting liquidity within those key 20, 40, and 60-day windows. And finally, you can use open interest to confirm that the institutions are on your side. Once you start seeing the market this way, you really can't unsee it. A chart stops looking like a random series of candles and starts looking like a deliberate story. So the question I want to leave you with is this. If price truly is a blueprint, what do you think it's building towards next? If you found this video helpful, do us a favor and hit that like button, and of course, subscribe to the channel for more. If you have any questions at all, drop them in the comments below and a real human will be sure to get back to you. Safe trading!